AMC stock update. Bulls fight back. Next stop, $3.
Right.
In short, it analyzes the stock holding support around 220 and argues that a strong Q4, thanks to Wicked Part 2, could push it to $3.
Yeah. It's a very clear high-stakes thesis. And I'll say, it does a good job identifying that floor at 217. You have to start there.
Of course.
But the immediate challenge, for me at least, is structural. It's about how the report handles the clock.
The ticking clock. You're talking about the fight back from that low, but all this optimism, it's sort of capped by the December 10th shareholder meeting.
Exactly. And that's our first big piece of feedback. The crucial significance of that December 10th meeting, it really needs to be woven into the very fabric of the bull case.
Not just like a footnote at the end.
Not just a footnote. Right now it's positioned as a standalone risk. And that's not quite right.
So when you say woven in, what's the weakness with the current approach? How does it undermine the argument for someone who knows this space?
Well, the current structure, it really risks minimizing the impact of that dilution vote.
Okay.
It sort of frames the rally to $3 as something that could happen in a vacuum. But the thing is, this huge uncertainty about the share count, it's just 2 weeks away.
Right.
So the entire bull thesis, everything you're talking about, it only exists within this tiny 14-day window. It's more of a binary trade than a real analysis.
And that timeline constraint feels what? Too lightly treated?
Way too lightly. It completely changes the risk profile. You're not looking at a steady recovery. You're looking at a mad sprint to try and capitalize before a potential reset.
That makes sense. So how do you bake that urgency into the main analysis?
The suggestion is to reframe the entire piece as a race against the clock.
I like that.
That framing, it immediately tells the reader the stakes are higher. It tells them that the catalysts you mentioned have to overcome this dilution risk in a sprint. And, it fundamentally challenges the idea that $3 could be a stable price.
Even if it gets there?
Even if it gets there.
Okay, I see it. If we're using that sprint mindset, what are some, concrete examples of how you change the report?
For sure. First, you introduce the December 10 timeline right up front. And the overview.
Don't bury it.
Don't bury it. Make it explicit that this is a tactical sprint, not some long-term fundamental trend. You have to manage the reader's expectations on the trade horizon.
And I'm guessing that means getting more specific about volatility than just saying, be wary.
Absolutely. You have to model that volatility. Where does it come from? Is it from shorts covering before the vote, which would actually drive the price up?
To lock in their gains.
To lock in gains. Or is the volatility from long-term holders getting out before a potential reset?
And those are two very different things.
Totally different. The source of that volatility tells you everything about whether it helps or hurts the push to $3.
And you can tie that directly to the technicals.
Yes. You explicitly link that 250 major resistance level to the meeting countdown. You say something like failure to reclaim 250 quickly, and you define quickly maybe in the first week. Means the dilution risk is probably going to overwhelm the momentum. That gives the reader a clear trigger to get out. The technical level becomes the stopwatch.
Right, that time pressure, it feeds perfectly into the next point, doesn't it? If you're in a sprint, you need fuel.
The perfect segue, you need a lot of fuel to get to $3. The path is logical. Hold 220, take 250, then go for the gap fill at 3.
But theory is one thing.
And execution is everything. And execution here means serious capital flow.
So let's zoom in on that technical analysis section, specifically that big leap from 250 resistance up to the $3 gap fill.
Right. This is the next major area for improvement. And it's all about volume. The technical thesis that links a break of 250 to a gap fill at 3, it just needs a much more robust justification for where that volume is going to come from.
The report does mention that the RSI, the Relative Strength Index, is recovering. That suggests momentum is building, doesn't it? Is that not enough?
It suggests the potential for movement. It doesn't guarantee the magnitude of the move. And that's the weakness.
Okay.
The analysis correctly says that a move to $3 is going to need volume that's at least 2 times the average. But then it describes the current volume as just, decent but not explosive.
Here's a gap.
There's a critical missing link. What specific event is going to create that explosive 2x volume you need?
It sounds a bit like it's relying on hope, hoping the gap fill acts like a magnet without justifying the energy needed to get there.
Precisely. You have to define the fuel source. So the suggestion is to really strengthen the connection between your catalysts, Q4, technical bounces, and the required volume. You have to detail where that aggressive buying, or more likely, short covering, is going to come from.
You have to make the volume requirement feel less like a wish and more like an expectation.
Exactly.
So if we assume it's a short squeeze, how do you make that more concrete for the reader?
You have to define the trigger, the specific technical level that forces shorts to cover and provides that 2x volume. Is it a close above Tuesday's high of, say, 233? Or does the real pain for them only start once it reclaims that big 250 breakdown level?
You have to pick the point of maximum pain.
The point of maximum pain. That's what forces their hand and gives you that surge.
That makes sense, but I wonder, isn't relying on a short squeeze always, a bit speculative? How do you ground that analysis?
That's a great point. You have to analyze the RSI recovery more deeply. Is that momentum strong enough to bring in institutional money, or is it just signaling more retail interest?
And retail volume alone probably won't cut it.
Retail volume is decent, right? But it historically struggles to sustain that 2x volume needed for a breakout in a stock this heavy with debt. Institutional conviction is what gets you past 250 for real.
Okay, so if the volume has to come from fundamental news to be sustainable, we should be really clear about what that news needs to look like.
Crystal clear. If you think early box office numbers for Wicked Part 2 are the driver, you need to specify how good those numbers have to be.
You can't just say good.
No, you need to say they have to be good enough to triple or quadruple daily volume from these decent levels. Give the reader a metric, something like concession revenue needs to hit an all-time high, not just beat expectations. That makes the report instantly actionable.
A very powerful challenge to the technicals. Let's pivot to the fundamentals themselves.
I agree. Let's look at the operational strength that has to, ultimately justify any kind of move.
So what I really like in this section is the focus on the holiday slate, especially what the report calls the Moana factor, that family traffic driving high-margin concession sales.
It's one of the strongest qualitative arguments in the piece, for sure. It recognizes that popcorn and soda are more important than ticket sales for the bottom line.
But
its impact feels dampened. It lacks a sense of scale when you put it up against the company's financial burden.
And that brings us to the third main critique. To really make that fundamental catalyst section pop, the argument has to quantitatively link that Q4 revenue surprise to the massive long-term debt and the cash burn we saw in Q3.
The weakness is that it's all qualitative right now. It says Q4 revenue will help offset the cash burn, and that debt remains the primary weight.
Which is true, but
How much more in concession revenue do they actually need to make a dent in the cash burn? Without that scale, the Q4 surprise feels too small to matter to an expert reader who is just staring at that multi-billion-dollar debt mountain.
So the argument needs to go from things will get better to defining how much better is required to actually matter.
That's it, exactly. Ground the bullish case in specific metrics. Make that Q4 surprise feel big enough to actually move a stock that is so fundamentally burdened. It's about setting a threshold for success.
So what's the practical way to do that? How do you make the fundamental argument hit harder?
You use those high-margin concession sales as your key metric, and you contrast the expected spending increase from families against the sheer size of the debt. Give it a so-what factor.
For example,
You could frame it like this. If per capita concession spending goes up by, say, $1.50 in Q4, that translates to an extra $150 million in operating cash flow,
okay.
which could fund operations for another 2 months and maybe take some pressure off from the debt holders.
And that immediately shifts the whole conversation from just box office hype to real, measurable financial impact.
It does. You could also frame the Q4 surprise as the percentage that operating cash flow has to beat expectations by just to stabilize the balance sheet. You have to address that primary weight of the debt head-on.
And this brings it full circle, back to the dilution vote risk we started with. This is where the fundamentals could actually change the story.
This is the most powerful move you could make. You link the fundamentals directly to that structural risk, instead of just saying Q4 will help offset cash burn.
Right.
You propose a scenario where a massive revenue surge is enough to actually delay or reduce the urgency of that December 10th vote. If the fundamentals are so strong they buy the company political goodwill, that adds real teeth to the analysis. It shows the company has options beyond just technical bounces.
This has been a really focused critique, especially for a report on such a tight timeline with that vote coming up. To recap the 3 big actionable areas, first, structurally integrate the December 10th risk.
Yep.
Frame the whole thing as a 14-day sprint. Let the clock drive the analysis.
Second, you have to justify that volume catalyst. Define the short squeeze trigger or the size of the news needed to get that 2x average volume for $3. Really focus on the source of the volume.
And finally, quantify the fundamental impact. Link that high-margin Q4 revenue directly to the debt and cash burn. Give the reader a real measure of how big the Moana factor success needs to be to actually stabilize things.
Look, the material has some strong catalysts and analysis, especially identifying that resilience at 217. But it means that structural integration of risk, more rigor in the fundamentals, in a much stronger justification for the explosive volume to really earn that $3 target.
We're excited to see the next iteration.